Get Rich Education is brought to you by Valhalla Wealth and Ridge Lending Group.
You're listening to the show that has created more passive income for people than nearly any show in the world. This is the powerful Get Rich Education.
Welcome to GRE. This is Get Rich Education, episode 176. I'm your host, Keith Weinhold, back to help you build your wealth. What are stock investors thinking out there? What are they thinking? Well, they think that they're getting ahead, and you know what? They are wrong. I'm not even talking about the recent bumps that the stock market has had, or even the longer run-up since 2009. Okay, let's just talk really long-term here. What are these people thinking? Let's look at the S&P 500 over the long term and call it a 10% return, okay? I'll give you that. Well, that's something that stock investors seem to be proud of. That 10% return, that's a return in name only. It's a nominal return. Nominal means in name only. Subtract the drags off of that 10% return. It's 10% minus 5% for inflation, minus 2% fees, minus taxes, minus volatility. Well, what is left over? What in the heck's left over? And then there's that emotional predisposition, that undeniable tendency, which you cannot discount, that gets stock investors to transact at precisely the wrong times, emotionally buying in off the momentum when the share price is higher, and then selling off the discouragement emotion when it's lower. So what the heck is left over? A real rate of return of minus 3.5%, maybe minus 5.5%, maybe. What if your account isn't subject to emotions, plus you pick really well? Well, then where would you end up? Plus 0.5% annually, maybe at best? Your 401k plan administrator doesn't want you to know this. Edward Jones doesn't want you to think this way. Charles Schwab doesn't want you to know this. They don't want you to consider these things. And 5% inflation, that really is more like it, not the 2% inflation that the government has been reporting for a while. If you're uninitiated on that, just read about the CPI, the Consumer Price Index, and how the government has an incentive to use the CPI to underreport how much they're really debasing our currency. A person that believes that the real rate of inflation is as low as 2%, I mean, that person might also believe that the real unemployment rate is as low as 4% that they're reporting to, okay? And I don't think that you believe that. Inflation might even be more than 5% right now, more than 5% true diminished purchasing power of the dollar over time. A lot of economists think it is. Inflation has been fairly tame lately, but most think that pro-business Trump policies are going to make it head back up again. So you need to buy something that substantially outperforms these drags. That's the lesson here. And slack-jawed stocks, bonds, mutual funds, and ETFs, they just don't do it over the long term. And you know, I might even be optimistic when I start off a mutual fund investor with a 10% nominal return before all these drags. Because if that investor is 80% stocks and 20% bonds, then it might be more like an 8.5 or an 8% nominal return per annum before all those drags on your return are factored in. That's why stocks, bonds, mutual funds, and ETFs just don't perform. What performs? Real estate performs. Real estate does it. Well, what kind of real estate? And, you know, there really are a lot of ways you can do it. You could get on the debt side and make a mortgage loan to someone else, and then you would be a mortgage note holder. That's probably better. At least you've got some income that way. But again, a 10% return on a mortgage note, well, that has its return slashed in half after 5% inflation. What about mobile home parks? That might work. We've talked about that here before with Kevin Bupp. What about assisted living homes? You can get a nice return there, but then you've got to realize, well, now an assisted living home, that's an active business. And you've got to ask yourself, well, do I really want to add a regular job onto my plate? And see, well, that brings us back to why we talk about residential, long-term, buy and hold real estate investing that generates you passive monthly income secured with long-term fixed interest rate debt. And see, now you have 5 simultaneous profit centers. And by now you could repeat them after me. Those 5 are leverage appreciation, cash flow, your principal pay down being made by the tenant. Fourthly, are almost outrageously good tax benefits. And then finally, the inflation profiting benefit when you borrow real dollars and get to pay back your lien holder in nominal dollars. What an incredible deal. Really, such that anything worse than a 25% rate of return is disappointing. And we've got to go minus 5% for inflation here with real estate too. That equals a 20% real annual rate of return. And I've added up how you can get to a 25+% rate of return from residential turnkey real estate on a lot of prior episodes here. But you know what? Things can and things inevitably will go wrong for you in real estate investing from time to time. That is just the nature of it. But long term, you know what? You almost have to be in real estate and stick out the bumps if you're really going to get ahead. Now, mortgage interest rates are up 0.25% to 0.5% in just the last 3 months here. That is a headwind. And you know, there's really not too much that you can do about that one. And wasn't it interesting earlier this month when Janet Yellen, she made her farewell speech, the outgoing Fed chair after she served for 4 years. She said that both stock valuations and commercial real estate valuations are high. You know, it kind of seemed like now that she's no longer the Fed chair, she could just go on ahead and say whatever she wanted. We'll see what kind of leadership we get with our new Fed chair, Jerome Powell. Jerome Powell was the Trump nominee, but there's not much you can do about those high stock and commercial real estate valuations either. When it comes to real estate, especially residential real estate, well, that's just been rising at 5 or 6% per year lately, and that is totally in line with historic norms. But still, let's talk about how you can avoid overpaying for a property. I don't want to see you overpay, and consider that this is going to be guidance for income-centric real estate investors. You might care more about appreciation or tax benefits more so than the income, and that's okay. Everyone is different. So when it comes to income generation, how do you know what the right price is? And how do you know when it's just too much to pay? Well, something you wouldn't say is you wouldn't say that $175,000 is a good deal for a property just because the seller originally asked for $200,000. Okay, that's not enough justification to say that that's a really good deal. Okay, when you want to buy a property, it has nothing to do with how much the seller asks. And you know what? It also has nothing to do with what the seller bought the property for 5 years ago when they're trying to sell it to you now. Okay, I want to specify here that we're just talking about valuation of income property here. How much value do you put on it? We're not talking about appraisals here. We're not talking about the replacement cost method or the income approach or comparables or any of those things with respect to the world of appraisals, okay? An appraisal, that's a tool that the bank uses to ensure the quality of the collateral that you're getting a loan against, okay? We're simply talking about how much a prospective property buy should be worth to you. And, you know, sometimes it is interesting because consider that 1 to 4 unit properties, single family homes up to 4plexes, they are appraised based on comparable sales, but yet you're valuing them based on the income that they produce. And that's where I want to help you today. So when you buy a property, you are essentially buying a money machine. You want to find out if this money machine works and if it's going to spit out the income. Does this money machine that you're thinking about buying, does it kick out the income that is going to provide the rate of return that you're after? Now, inside this money machine, imagine that it kind of has 3 turning gears inside the machine that make the machine go. 3 of these sprocket-looking things, okay? One of these gears is an income gear. One of these gears is an expense gear. and the other gear is a financing gear, income, expenses, and financing. Okay, first, let's look at price per square foot as a valuation measure. Price per square foot is a horrible valuation method for you. That's because it doesn't account for any of those three gears of your money machine. Price per square foot says nothing about your income, your expenses, or your financing. All right, well then, what about price per unit then? That's another poor valuation method. Price per unit, that doesn't account for any of your three gears either. All right, then how about a third valuation method here? And that's one that I've discussed on the show a lot. That is the rent to value ratio, also known as the rent to price ratio. All right, well, now we're improving a bit here, but it's still such a simple calculation that it's lacking. Rent to value, that tells us quite a bit about our income gear, a little something about our expense gear maybe, but it says nothing about that financing gear inside this money machine. And remember, whenever I've brought up rent to value ratio, I've called it a quick hit number. It's a topical number where you can just kind of quickly do the math in your head before you even consider drilling down and running a profit and loss statement. All right, well, how about a fourth method then? Now, this is one that you really don't seem to hear about as much as you used to. It's kind of in more of these old school real estate investing books, and it's one that I don't like very much, and that is GRM, Gross Rent Multiplier. GRM, that is basically just the price for an income property divided by the annual rent income. So it doesn't account for expenses very much, and it doesn't account for your financing sprocket gear thing at all. How about a fifth valuation method, capitalization rate or cap rate? Now, you hear a lot about cap rate out there. It's something that's used by the big guys like insurance companies, and it's used by pension funds. So why do the big guys like this, why do they use cap rate? It's because they buy with all cash, and cap rate does not consider financing. Cap rate is the building's net operating income divided by the property value or price. Net operating income, that is all the building's income minus all of its expenses. Expenses like property vacancy, insurance, maintenance, taxes, utilities, and management. Take that NOI number and you divide it by your property's price. Now see, notice that mortgage principal and interest was not in there. That's not part of cap rate. So if a building produces $83,000 of NOI, net operating income, and the building is selling for $1 million, that's an 8.3% cap rate. Said another way, what's an 8.3% cap rate really mean? The property produces 8.3% of its cost in annual NOI. So cap rate is still lacking measure in valuing this property, but it's getting better. Okay, so cap rate considers 2 out of the 3 gears of our money machine, each one except for the financing gear. Now, you can still crunch a cap rate and get a loan for the property, of course. You want your cap rate to be greater than your mortgage interest rate. That means then that your property is stronger than the loan. That difference is also known as your arbitrage, where you're borrowing money at a lower rate and enjoying a return at a higher rate. So we've covered, 5 valuation methods, and we still don't have a great one here. There are a lot of methods out there. A lot of them are just junk. Now, there are some good realtors out there that know income property, but most realtors, agents, licensees, they just don't know what really matters to an income property and what really matters to investors like us. And you've just got to realize that if they're quoting your price per square foot out there, your price per room or something, I mean, that is just really limiting. You're going to need quite a bit more than that. So let's look at a 6th and final valuation method here. And finally, it is a really good one. You might know what it is. The value calculation that tells you more than all the others because it includes all 3 gears of your money machine. It includes your income gear, your expense gear, and your financing gear. That is the cash on cash return. Yes, the cash on cash return accounts for income, expenses, and financing. It's the best. It focuses on your before tax cash flow as the most important consideration. Now, in year one, your cash-on-cash return is your annual cash flow divided by your down payment and closing costs. After year one, your cash-on-cash return is your annual cash flow divided by your property's equity. You'll see cash-on-cash return abbreviated in a few different ways. CCR, COC, or even COCR is what you'll see sometimes, but it just all means the same thing. It's all cash-on-cash return. It wins the valuation crown here. It is the best method, and as devoted Get Rich Education listeners know, cash-on-cash return is just one of those 5 simultaneous profit centers that you have. Now that cash-on-cash return was coronated as the valuation champion here, let's just compare cap rate and cash-on-cash return, which are the last 2 valuation methods that we talked about. Because some people out there say, sometimes we'll hear like, gosh, that is just so dumb that cap rate includes almost everything about a building's operation, but then it goes and excludes the financing. So people are like, now why is that? Okay, you know how if something doesn't make sense, well, then it can be more difficult for you to comprehend. It just doesn't sink in if it doesn't make sense. Well, just try to remember it this way, and it might help you. How a property is going to operate regardless of the financing. The property didn't come with a loan. You brought a loan to the property. Financing is specific to you, not the property. With or without a loan, that property will have the same operations, the same heating bill, the same vacancy, the same property tax, whether you have a loan against it or not. That's why when someone advertises a property for sale out there in a listing, they'll show the cap rate more often than the cash-on-cash return. Because whether someone pays all cash or gets an 80% loan or whatever, cap rate stays the same. So they're telling you how the building is expected to perform. If a property is for sale and the property does quote the cash-on-cash return, well, then it's going to have to go ahead and make a bunch of assumptions on what kind of financing they think that you, the prospective buyer, is going to bring to this turnkey single-family home or 8-plex or whatever it is. Now, realize that if someone were to pay all cash for a property, well, then the cap rate and the cash-on-cash return would be the same. When it comes to not overpaying for a property, there's another tip I've got for you here. When you're trying to determine if your money machine works, and now this one is especially true of 5+ unit properties, you want to ask the seller to see their Schedule E form. Look, when you're getting a property under contract and you're doing your due diligence, you're having your inspection, you're perhaps getting estoppels, look, the seller might try to show you that the property produces a high income and low expenses, therefore a higher NOI, meaning a higher cap rate because they want the highest sale price, of course. But every year, that seller should be submitting what's called a Schedule E form to the IRS. And Schedule E is really nothing that complex. It's just nothing to be intimidated by. It's just a form, a sheet of paper, where property owners report their property's income and expenses to the IRS every year. But look, and right here is your aha moment. While they held onto that building, that property owner wanted to pay as few taxes as possible. That means on Schedule E that they might try to show the IRS a low income and high expenses. Yes, that's the exact opposite of what they would want you to think when they were trying to get you to pay a high price. So you want to make your purchase offer contingent upon seeing the seller's Schedule E. Now you've put yourself in a substantially better negotiating position, and you can really avoid overpaying for the property. And again, that Schedule E tip, that's just not going to apply so much to turnkey single-family residences as it will larger apartment buildings, but it's a great one for you to keep in mind. And when you know to ask for that Schedule E, the seller is going to know that you're a savvy buyer. Now, after all that's been said, consider that this is direction for income-centric investors when it comes to how you evaluate a property for purchase. You might not actually care that much about cash flow. You might care more about appreciation or tax benefits or inflation hedging or lifestyle investing or something else. And there's nothing wrong with that. But if you want real estate principally for the production of income, now you know more about how to avoid overpaying. I care about you. I want you to build wealth. I want to see you buy lots of real estate, but I don't want you to overpay for a property. Well, hey, I am in my hometown of beautiful and pristine Anchorage, Alaska today. And gosh, I'll tell you, the Tourist Bureau here in Anchorage really should give me $1 for every time I've used the adjective beautiful and pristine to describe this place on the show. Tomorrow, I'm heading to Placencia, Belize to check out some resort real estate. Again, just look on a map. This is pretty long distance travel. I'm actually going to be in 5 different airports tomorrow. Anchorage International, Denver, Houston, Belize City, and then finally, Placencia, Belize. I'll let you know if I find anything worthwhile down there from an investment standpoint. Coming up next year on the show, interestingly, we're going to talk to a guest that invests in both real estate and stocks. He's probably aware that stocks have exceeded their normal appreciation rate lately, and he's going to talk about taking money out of stocks and putting it into real estate. We're also going to talk about one particularly fast-growing real estate market. You're listening to Get Rich Education, the show that's created more passive income for people than nearly any show anywhere. I'm Keith Weinhold. This is Get Rich Education. MC Laubscher is the host of the top-rated business and investing podcast, Cash Flow Ninja, and also the president and chief wealth strategist of Valhalla Wealth. They help busy people build wealth outside of Wall Street by strategically combining their clients' cash flow statements with the financial vehicle of the wealthy, according to the infinite banking concept. If you are interested to learn how to perpetually multiply your wealth, you can access an exclusive webinar at yourownbankingsystem.com. Cash flow real estate investors, if you're looking for a mortgage loan with a company that specializes in investment property loans, it's Ridge Lending Group. They provide income property loans in almost every U.S. state. Ridge has worked with tens of thousands of investors and homeowners all over the country. In fact, with ethics and transparency, they've helped more people realize their dreams through real estate investing than any other mortgage lender in the country. Get started at ridgelendinggroup.com.
This is Norada Real Estate's Marco Santarelli. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Representing the bustling market of Charlotte, North Carolina, welcome to Get Rich Education, turnkey real estate provider extraordinaire, Aaron Adams.
Thank you, Keith. It's fantastic to be with you again.
Oh, it's so good to have you back. You know, when a lot of people think about Charlotte, they might think of a fast-growing East Coast city, but Charlotte, first of all, it's not on the coast. It's in southwestern North Carolina, and it has, though, experienced torrid growth. I mean, we're talking about a metro, Aaron, that's grown more than 35% between the 1990 and the 2000 census, 35% again between the 2000 and the 2010 census, and it's just continued. That's growth rate. The metro area now has more than 2.5 million people. Charlotte, North Carolina has grown to the 17th largest city, and more than half of Fortune 500 companies have a presence there. More than half of them are in Charlotte. So, Aaron, just talk to us more about the growth drivers and the market sectors there in Charlotte.
There's some really unique things about Charlotte. A lot of people don't realize that outside of Wall Street, Charlotte is the largest banking center in the country, and that really drives a lot of the economic growth there. I've worked with investors all over the world, and many U.S. investors realize that Asian investors, for example, are aggressively acquiring property in the U.S. They're in California, they're in Florida, they're in Chicago, New York, even Texas. One of the areas that Asian investors are not investing in yet that really isn't on their radar is Charlotte. Charlotte's kind of one-off because it's not coastal, because it's not an area with a huge, diverse demographic base. I mean, you have your white, you have your black, you have your Hispanic, but you haven't seen that influx of Asian populations that would relay that back. I mean, when you look at the economy of Charlotte itself, if Charlotte were a country, it'd be the 60th largest economy. I mean, it's larger than the nation of Angola and Morocco. Gosh. And so, it's not just banking. If you were to look at the census of jobs, there isn't any one industry that dominates more than about 3%. And that's robust. That's healthy. That's why you have the second hottest population growth in the nation and why publications are forecasting Charlotte to be one of the top 3 or 4 hottest markets for 2018 and 2019 for real estate investing.
Yeah, so when you got more than half of Fortune 500 companies there, that would match up, that no one real sector or industry takes more than 3% of the business share. So we're really talking about thriving banking. You mentioned it's the second most bustling banking metro in the United States to New York City. Bustling medical, bustling technology. And I kind of think of it as more of like a blue chip market in the turnkey real estate and investment world, kind of like a Dallas, where, you do have this rapid population growth. It probably does give you a better chance for appreciation than most any other market. And the cash flow is somewhat thinner, although you can still find it there.
There's 3 things that I really look at. I look at unemployment, and I look at how a market performs against the region, and Charlotte annihilates its region. The percentage of growth in the workforce over the last 10 years is just off the charts. But then I really look at salaries. I mean, salaries are over $60,000 a year when you're looking at a median income in Charlotte. And compared to median home price of about $150,000, $160,000, it creates extremely high affordability. So when there are jobs and when you have a robust economy, people are moving there and they're able to buy homes. And that's why you see such a continued sustainable large growth over the next 10 years.
And that's the sort of thing with both job growth and wage growth that can support rent increases.
Absolutely. And we've noticed, over the past couple of years, we've been seeing 5 to 10% rental increases per year. Now, do I think that's sustainable over 10 years? No, I don't think that's realistic. But do I think that an investor who were to pick up a property here in the first, second quarter of 2018 would see that over 24 months? Absolutely. And when we go into neighborhoods and we try to target neighborhoods in Charlotte that have an exceptional reason for not only a rental growth, but also appreciation. So we're trying to buy in neighborhoods that maybe used to be lower income, but are now transitioning to middle class because there's light rail going in, or because there's new infrastructure projects going in, or because there's new convention-related downtown type projects. Those local projects end up being drivers for both rental increases and appreciation. And so the investors that we sold properties to 1, 2, 3 years ago have seen double-digit appreciation every year on those properties, and about 5 to 10% rental increases every year or whenever the tenant moves out.
Yeah, that's really phenomenal. Anything else that you look for in neighborhoods when you're looking to pick up a property in your portfolio to rehabilitate it, tenant it, and then go ahead and sell it to that investor?
We want it to be dynamic. I mean, we get an older investor. I like to say that my retirees are in 3 stages. There's the go-go stage of retirement, the slow-go stage, and then the no-goes. And obviously, my no-go clients that buy properties from us have no interest in high-growth appreciation. They want like Andy Griffith, Mayberry type neighborhoods. My no-goes are like my 75 and olders, my 80 and olders. But if you're younger than that, you want appreciation. I mean, obviously, you don't realize that gain until you sell the property. But if you have a home that you can buy for $100,000 in Charlotte, you can make 7 to 10% from the rents net every year, and then you can make 10 to 15% appreciation, then you really are sitting on an asset that can fuel some fantastic growth for your passive investments.
Yeah, I've said it here before, Aaron, cash flow is what helps an investor control the property. But like just me in my own personal life, when I've owned a property for quite a long time and then I've sold it and I sort of do this forensic analysis to see where my return comes from, almost every time I got a greater financial benefit from the appreciation than I did from any cash flow.
I have some fantastic relationships with private equity. We bought hundreds of properties for these big Wall Street funds that are buying up America. A lot of people don't realize that Wall Street has purchased almost 3% of America in the past 5 years. But investors that have bought properties from us have access to those relationships, and we regularly sell these Charlotte properties to these big Wall Street funds. So imagine a scenario where I were to sell you a home for $90,000. You make 8% from the rents for the next 2 years. And then I come to you and say, hey, I got this big Blackstone private equity fund that wants to buy the property for 120. And that's your chance to exit it, bank that appreciation, and convert back to liquidity. And that's what investors are getting when they work through our system.
Well, I want to talk to you more about how investors go about acquiring properties there in a moment, but let's talk some more about the character of the property itself. You've mentioned a typical sale price of $150K to $160K. Let's just talk a bit more about the numbers. Like, for example, we're talking about single-family homes, bedrooms, bathrooms, rent income, and so on.
Yeah, actually, typically our Charlotte properties are a little bit more affordable. We like to be right under the median home price in a community because that is an indicator of growth. So a lot of our homes are in blue-collar neighborhoods, typically $100,000 to $120,000, rented out for $1,000 to $1,300 a month. We don't do condos regularly. For the most part, single family, freestanding homes, 3-bedroom, 1-bath, 3-bedroom, 2-bath, sometimes 4-bedroom, 2-bath are very typical. And if you know Charlotte, or if you're familiar with Charlotte, we love the downtown area of Charlotte. We like the west side area of the Charlotte Metro, out towards and west of the airport in Gastonia. We've done really well in those neighborhoods because of the growth and because of the change that we're seeing.
Just anything else about the character of the properties and or attracting tenants to them?
As you know, we're in Indianapolis, we're in Kansas City, we're in Dallas. Charlotte's one of our markets. Charlotte's probably our easiest market to rent in. Because of the growth that Charlotte's experienced, there's a war for rental properties. So we usually see vacancies of only a couple weeks from the time that our properties have been rehabbed and are on the market. They literally go instantly and regularly for $25, $50, $75 higher on that next 12-month lease than they were previously. And so, sometimes I'll get an international client that'll say, well, what happens if it doesn't rent? And that's not a question that I can even get my brain around because, worst case scenario, you drop the rent $25 and it instantly fills. Quality tenants are competitively looking for quality property.
How do your investors go about purchasing property? I know it's somewhat different than how some providers work.
For the most part, we've really focused on becoming a passive retirement solution for many investors. I mentioned earlier that I have a lot of older retired clients down in Florida that are diversifying into real estate with us. You and I were chatting previously, and I'm a big fan of the stock market. I actively trade options in the stock market, and this year was a banner year. I've been killing it in the market for the last 9 years. I'm up 65% just this year alone. And it's going so well that it makes me nervous. And I made the decision this year I took almost 75% of my profits and diversified back into real estate and took that cash out of the market. 85% of the people that buy homes from us are taking money that they have in an IRA or a 401k and using it to buy properties cash from us, looking to bank and lock in those profits that they've made in the market and diversify into the real estate market. A lot of investors don't realize it, but when the market crashes and goes down, rental rates increase. And I've been doing this for 18 years, and I watched the market in 2008 where the stock market crashed, real estate prices crashed, but rents went up. And so if you're able to lock in a property in your IRA right now, and your IRA buys, for example, a house in Charlotte for $100,000, you're making 8% on the rents this year. Hypothetically, if the market were to crash, over the next couple of years, your rents would increase. You'd be making 8.5%, 9.5%. And so it's a great way to diversify and to hedge against a future downturn. I mean, obviously, nobody knows what's going to happen. Nobody thought that the market would be as strong as it was this year, and we're at record numbers. But there's never been a time in history where it's just kept going and going up. We're almost at the 10-year mark. Nobody realistically thinks it's going to continue on that path. And so 85% of my investors are using all cash money in an IRA, in a 401k to buy these homes from me. And if that's something you're not familiar with, we actually teach you step by step how to do that, how to take money in those retirement accounts and have your IRA own a rental property. And every month I'll send the rent to the IRA as the growth. It's a very unique offering that we can help you set up. And just not a lot of investors know or are aware that their IRA or their 401k can own rental property.
Oh, there's just so much to touch on there. I often talk to investors about how, well, a lot of times they're thinking about, whatever saving they need to do to get liquid to go ahead and purchase their next property. But what do you already have right now that you can go ahead and use and leverage into more property? And, for a lot of people, it might be something related to stocks. We're on one of the longest stock bull runs that we've had. And this is an opportunity for that stock investor to basically lock in their profits and buy an asset that produces income.
You figure a typical worker gets their job at 20, they're a W-2 employee, their company gives them a 401k, they didn't really understand what they were getting. Maybe that 401k is managed by Fidelity, which is the largest manager of retirement funds out there in the country by far, trillions of dollars that they have under management. And when you look at a Fidelity managing your retirement money, they've been averaging for you over the last 15 years about 4% growth per year. If you were to buy just a rental property in Charlotte at our low end yield, you'd be making 7% just from the rents and almost double the return that the Fidelities of the world have been making for you with your money. And so when we teach investors how to use a self-directed IRA to take charge of their retirement and to diversify into real estate and let their retirement account own property and get the benefits, the tax deferred and sometimes tax-free benefits of rental income and appreciation, then they get really excited about it. And I think that many, many investors are just not diversified enough. I'm not suggesting that you take all your money out of the market, but I am suggesting that you consider diversifying into real estate because that opportunity is there. And we educate investors every month on how to do that.
Now, you often talk about the benefits of going ahead and paying all cash for a property. And I've talked at length on this show about how leverage has created quite a bit of wealth for me and how that can really amplify your wealth when you have a loan on a property. But there is another side to that, and that's the all cash angle. So just tell us about the benefits of paying all cash for a property versus using leverage.
You know, I'm a huge fan of leverage. And when I started investing, I was actually teaching high school in California back in 2000. And leverage allowed me to make my first $1 million, my first $5 million, my first $20 million. At some point, though, 100% leverage in your home, in your investments, doesn't make sense. And so by no means am I anti-leverage, but I am pro-diversification. And at some point, you should consider having some high liquidity, lower leveraged portion of your total net worth. Maybe for you, it's 10%, maybe it's 25%. But good investors have a high liquidity portion of their portfolio. They keep their money in precious metals. They keep it in cash. Maybe you just keep it in the market because it has very high liquidity. But I think that a good balanced net worth also includes some unleveraged piece. And so when I look at my passive net worth and the portion of, I have my active income and I have the passive portion of my net worth, I like to hold the passive portion of my net worth unleveraged. I love leverage to increase my net worth vis-a-vis my active income, my flips that I do, the apartments that I buy, the mobile home parks, the single family homes. But then I like to take the properties that I'm keeping long-term and keep those unleveraged, especially the ones that I hold in my IRA or in my 401k. And so when I teach and talk to investors about leverage, I like them to think about, what percentage of your holdings should be unleveraged. And the litmus test is whatever helps you sleep best at night. If you sleep good at night with 100% debt, top to bottom, and your full net worth, then more power to you. I know that I don't.
And some investors just need to realize that it's not a one-way street. If you do go ahead and pay all cash for a property, well, now you've locked it up. Now you've got control of it. And depending upon your circumstances, now you can go ahead and get a loan on it, maybe 80% loan to value, after you've already got it under control using all cash.
Yeah, in fact, sometimes I find that if you wait 6 months and then refinance the property that you bought free and clear, you'll get a better financing term than if you were to use acquisition debt to buy the property. So, if you buy it, you got to put 20, 30% down. Whereas if you refinance it and you have some equity in it, which most of our properties do, then very often you're able to refi 85, 87, 90% of your money, which essentially reduces the down payment that you have to tie up into that property. And so it's not like you close the door forever on debt by buying a property free and clear. I actually think it gives you more options. And I find that many investors will buy a property free and clear, and it's nice getting $500 a month for a $70,000 investment or $700 a month for a $100,000 net of expenses. And a lot of investors go, you know what? It's kind of nice. I like that. I don't have to worry about that mortgage payment.
Well, any final thoughts that you have, Aaron, on investing in Charlotte, North Carolina income property?
Charlotte's hot, and one of the things that our team does is we focus on growth markets and we focus on cash flow markets. We were in Texas until we felt like Texas was overvalued, and now we're selling Texas. Same with Florida, same with California, same with Vegas. And I love Charlotte right now, but if it became a market that we didn't feel our investors could create value and get good deals, then we would stop buying in Charlotte, and we would help you liquidate those properties. But, we still have one property in Florida of the many, many properties we sold our clients that we still manage for our investors. And so our team is with you every step of the way, and we take a very national view of investing. And so you have the security that we've done our homework, and we will be in that market until it doesn't make sense to be in that market. But we absolutely love Charlotte right now.
Well, Aaron's put together a great report for you specifically on the Charlotte real estate investment market today. You can go ahead and get a hold of that at getricheducation.com/Charlotte. And you can also connect with the provider that way and find some income property. That's at getricheducation.com/Charlotte. Aaron Adams, thanks so much for coming on to Get Rich Education today.
Always a pleasure, and we love interacting with your students every chance we get.
Well, yeah, Aaron is a great resource to learn from. Major stock indices have surely exceeded their long-term historic appreciation averages over the last few years. Many stock price to earnings ratios are fantastically bloated. And we've talked to someone that is taking his stock profits and converting them into real estate. You can find properties in a fast growth market like Charlotte, North Carolina, again at getricheducation.com/Charlotte. Until next week, I'm Keith Weinhold, and I'm here to help you build your wealth. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Ranked by Forbes as one of the fastest growing cities, Orlando, Florida has a big and diverse economy, yet still features affordable rental properties that cash flow. Our boots on the ground turnkey provider, Greg Bond, wrote a special report to help you discover the amazing market of Orlando. Request your free copy today. Visit getricheducation.com/Orlando. That's getricheducation.com/Orlando.
The preceding program was brought to you by your home for wealth building, getricheducation.com.